good afternoon to some and good morning to others. It's kind of that time of the day where we're kind of right in the middle there. So I'm Leonard Burkelson. I'm the director for all health-related products here at Financial Brokerage. We've invited you to join us today to learn a little bit about National Guardian Life and their long-term care product that they're offering across the country. We have Lawrence Vivenzio, who is the regional with National Guardian. It's going to kind of take us through that process today and the reasons why you should consider National Guardian when you're looking at long-term care coverage. There's not a lot of carriers that are in this market, so every one that we have in the traditional space is very important. And I think that National Guardian's got some things that are really unique that I think we're all going to be able to find very useful when we're talking with clients and positioning long-term care with those same clients. So with that, I'm going to turn it over to Lawrence, and you take it away, my friend.
Geez, what better introduction could I ask for than that, Leonard? Thank you so much. I appreciate it.
Yep.
Man, you teed the product up. I don't even need to do much anymore. That was great.
Okay.
So, hey,
all
everybody. Right. I appreciate you all taking some time to learn a little bit more about NGL and our long-term care product. By the way, inadvertently, that pretty much describes our agenda for the rest of our time together today. I'm going to take maybe 20% of my time with you and talk a little bit about who we are as a company, because you will get those questions. And the other 80, we're really going to focus on our product and those things that Leonard stated make us pretty unique to today's marketplace. So to begin with the former half of that, at least when I was out there in the field selling, I got 3 questions from my clients. And those 3 questions were, how long have you been around, or this carrier that you're mentioning, right? Because I've sold other carriers that were not exactly a household name, right? How long have they been around? What do their financials look like? And how are they rated? Those were my big 3. That's why those are the first 3 bullets on your screen right now, by the way. My answer was what those first 3 bullets are, right? So for NGL's story, you say, hey, NGL is a mutual company. Yes, that's not on your screen, and yes, we are a mutual company that's been around for over 110 years. They are A-rated by AM Best, and they have roughly $5 billion in consolidated assets. So in one very short paragraph, you answered those big 3 questions, right? Been around for nearly forever. A-rated, solid assets. What else could you ask for, right? Forgive me, I muted myself for a quick gulp of water there. I don't want to be coughing in everyone's ear. So that addressed most consumer questions about the carrier. At least that's what I found when I was out there in the field. Now, the real savvy consumer would then ask, hey, how long has this company been in long-term care? And the answer to that question is since 2016. If you know long-term care and this history of the industry well, you know why that's a very good thing. If you don't, let me tell you the story. Or if you need some talking points around that, let me tell you the story. So my nutshell when I was talking to a consumer would say, look, Mr. Client, long-term care insurance really only got popular in arguably the mid to late 80s. So for this industry and this type of a product to really grow and blossom at any level, it needs a whole lot of time. So it wasn't until 2010 or so where as an industry, we really got good claims studies and significant claims experience to be able to look at this thing and say, here's what we're doing right, here's what we're doing wrong. Before that, actuaries were really just taking educated guesses. And turns out, as an industry, we made a couple mistakes. We priced this stuff way too low. We underwrote it way too loosely. We underestimated claims instances. We underestimated claims duration. We overestimated lapse ratios. There was a lot of stuff that just you had to figure out as the product grew up and the industry grew up into its adolescence from its infancy, right? So why is it a great thing NGL jumped in 2016? As an industry, we learned a whole lot by then because now we have great claim studies. We have a huge volume of claims. We know where the mistakes were made with pricing and underwriting and actuarial assumptions around claims. So that's why it's a great thing we jumped in 2016. And we partnered with an administrator who's been doing claims and underwriting for over a dozen companies over 30 years. So with that experience, we've created a product that's not only competitively priced, and I will show you some of those comparisons, but we have features that other products just don't. Because some of those carriers that had products 10, 20, 30 years ago are afraid of them because they had so many of them that were very, very underpriced for their time. So today, we know how to price this stuff, we know how to underwrite this stuff, and I think you'll find a very interesting product offering. Now, before I delve into those features, I always get the first questions on availability, and I apologize, my map is yet to be updated. We are available now in all states except New York. Okay, so Montana being gray needs to change to being blue. And that happened just last Friday, so that is why my map is out of date, and I'm sorry for that. Okay, so we addressed the availability question. Now we can talk about the fun stuff. So if there are 5 things that differentiate us from the other traditional carriers on today's market, I believe they are the 5 things that are on your screen right now. Don't feel like you have to write them down. I'm going to go through each and every one of them. By the way, before I delve into this first one, Leonard, any questions or anything that was typed in just yet?
Nope, nothing yet.
Okay, good deal. By the way, I am happy to field those as we go along, so feel free to interject or ask questions, or if you have anything to add. I always feel this is more entertaining for the user if we have a little back and forth, so don't hesitate to interject. I'm more than happy to make this a conversation rather than a presentation. So that said, here's your first big shiny object within the product. And this is going to be my first compliance sounding the alarm statement of the session. I truly believe that if you are talking to a couple about long-term care planning and you don't bring up this product, you are leaving a compelling option off the table. I say that very emphatically and factually, because I'm very familiar with what's out there on the market, and I believe in the way we built this product, and it is very, very beneficial to couples. So let me tell you why. One of the reasons, when you sell a competitive product that's out there, traditional product, you're usually selling 2 policies, right? Mr. and Mrs. Client are on your screen. They each have their own policy, separate policy numbers, and then they each have their own premiums, and you have to add them together to figure out what they're going to pay every month or year, right? We tried to simplify that part of the process for you in just creating a joint policy. So as that rounded rectangle appears on your screen, that represents the joint policy. And what used to represent 2 separate individuals with different policies, now they're in that rounded rectangle. So those 2 blue circles are now separate pools of money within one joint policy that also has a joint premium. And since it is a joint premium, that makes it a joint waiver of premium. So if either one is receiving benefits, premiums are waived. Okay. Now, there is no circumstance where either one of them will ever touch each other's benefit pools. There is no path to do so, which is generally what happens on competitive products, right? One, once you use your all, you can pull from the other. But then that second person could be left with little to no benefits, right? Well, with us, we didn't call it shared care like you're used to. We called it the shared benefit amount rider because it is truly a separate third benefit amount. And it becomes available once you exhaust your own policy. So Mr. Insured just did that on your screen. Remember, he's never going to touch hers because he has a pathway to get into that third separate shared pool. Now, if he needed all of it in his claim scenario, he could have used all of it, but let's say he uses about 80% of it there and passes away. Well, Mrs. Insured has all of her benefits left because remember, he could never touch hers. So if she then, a couple of years later, goes on claim and exhausts all of her pool of benefits, she can then follow a similar path and use what was left in that shared benefit amount. So a joint policy, 2 separate pools, and the shared benefit amount rider is a third pool available to either or both once they exhaust their own pool within the joint policy. Now, this is the what is it and the how it works. How does it compare? So on this next slide, look at the silver bubbles on the bottom first. Okay, look towards the bottom of that slide. That is a $225,000 difference between us and a competitive carrier, just in available benefits because of the difference in the structure of the plan. 3-pool model versus a 2 separate policy with a break in between model. That is not a small number. Account for inflation over 30 years. That'll be about $500,000 in difference. Now, if you've already looked at the top of the screen, you see we do it in a very price competitive way. Yes, it is less premium for more of a flexible policy structure and more benefits. So, back to my compliance unfriendly statement. I truly believe if you're talking to a couple about long-term care planning and you don't bring up this product, you are leaving a compelling option off the table. And I'm hopeful, now that I've had about 6 minutes to explain why, you agree with me. So that is one of my first big high points of this product. And I think this is probably the most interesting piece of this product, in my opinion, that you could be talking about with your clients. So if you're talking to a couple, you absolutely need to bring this up. Now, singles, how do we do with singles? That's usually the question that comes in the chat box once I'm done talking about this point. We do very well with single applicants. We are going to win some. We are going to lose some. Run both carriers and see how we pan out. But I will tell you, if you are selling inflation, 3% compound, then we will compare very well with singles too. We are in a very good competitive spot in the marketplace today. So I will be impressed if you're finding consistent scenarios where we do not fit well. Okay. And Leonard can help you with those comparisons as well, but I'm happy to back him up in any way possible or work with you. Whatever we can do, we want to make sure you're positioning the best product for the client. And that won't always be our shoe to fit that situation. But when our shoe does fit, it fits very, very well. Okay. So, next interesting piece of this product. I'm the only traditional carrier on today's marketplace that has a lifetime unlimited benefit period. In fact, in the entire marketplace, traditional or hybrid, I am only one of 2 products that has a lifetime unlimited benefit period. Okay, but I'm the only traditional one that's got it. Your other choices are 2, 3, 4, 5, or 6 years. Okay, so you have some good flexibility there, 2 to 6 or lifetime. Now, an interesting play that I pull out of the playbook sometimes when someone wants to consider lifetime, show them lifetime. But I would also then, especially if it's a couple, urge you to show them a 5-year shared. Think about that for a second. 3 5-year pools of money. Statistically, how many couples are going to need 15 years worth of care? Not very many. Is it lifetime unlimited? No, but it's the next best thing. It costs a whole bunch less. So you've kind of been the LTC specialist superhero there in getting them a very large, robust plan and saving them money when they tell you they want lifetime. But the time to check the lifetime box is when you have that client that just wants to pay for that ultimate peace of mind in knowing that come anything, their policy will never run out of benefits. We are the only traditional carrier where you can select that option for them. We're also the only traditional carrier that has a single premium payment option. It is fully paid up on day one. It becomes a non-cancelable contract. It can never get a rate increase, and we can never ask for another penny of premium. Now, we also have a 10-year premium payment option. In all states except California, our 10-year pay is fully guaranteed from day one to never get a rate increase. I'm the only carrier in the traditional business that can say that as well. Now, in California, our 10 pay can get an increase, but only during those 10 premium paying years. Once it's paid up, it's paid up. So you insulate your likelihood of getting one for 10 years instead of the life of the policy. So you have, in most states, two ways to guarantee traditional long-term care insurance premiums today. NGL is the only carrier you can use to say that. Now, we do also have your traditional lifetime pay. I cannot say it is guaranteed premium, but we did talk a bit about when we entered the industry, our position in the industry, and how confident we are in what we're doing today compared to carriers of 10, 20, 30, 40 years ago. Well, 40 would be too many. Oh, maybe not at this point. We're close. I believe the first long-term care contract was sold in 1978, so we're there. We have a good story to tell with what we now know about claims and underwriting and how this product is priced and our risk exposure thus far. So I cannot say my lifetime pay is guaranteed, but I can say my single and 10 pay are guaranteed. Okay. Now, yes, I'm a traditional product, but I also have ways to create benefits at death or surrender values. So I'm talking about some of these features, and it's starting to sound a whole lot like an asset-based or hybrid or linked benefits, whatever you like to call them, type of a product. But I do it all on a traditional chassis, creating that same value proposition. If you need care, there could be a benefit. If you die and you don't, there could be a benefit. Or even if you think you might consider canceling this thing, there could be a benefit. So you have the flexibility with this product, when you look at the three bubbles on your screen, to just sell, live. Or check a box. Then you have a live, die. You check another box, you have a live, die, cancel. I don't know any product anywhere in today's marketplace where you have that flexibility to pivot like that. So I go back to that theme of this being a flexible, moldable product, depending on what your client says is important to them. This product can fit many of those situations. So that's the what. Here's the how. We do it through this thing called a limited return of premium right. And the way this thing works is we look at premiums paid, we look at any benefits received as claim payments, subtract one from the other. If anything's left, that money goes to the beneficiary. And of course, like the true hybrids, if your claim is much larger than their death benefit, or in our case, premium, the beneficiary would get nothing. Okay, so that's the functionality of the return of premium right. Now I have a second one that looks just like this, but it adds a surrender value schedule that grades up to 80% of premiums paid at the fourth year. So while they're still alive, in year 5, for example, they say, nope, I don't want this thing anymore. We'll give them 80% of their premiums back. Policy is null and void. It's an option. Now, most people never lapse their long-term care insurance, so that's why I love the flexibility here to just add the die benefits to the live. You don't automatically have to do live, die, cancel like you do on every single hybrid, by the way. Speaking of hybrids and executives for that matter, we're running into a lot of scenarios where businesses are considering hybrid policies for executive style benefits. Well, I want you to know that there could be a much better tax story to tell on the traditional side here, because none of my product is on a life insurance chassis. It is all on a traditional long-term care insurance chassis. So that premium, say for a C Corp, could be fully deductible. Now, I have a program for the worksite that utilizes a unisex employer group rate class. Okay, but that rate class, you don't really have to use it. The business cuts the check. The business can deduct it. So if you're just carving out, say, the owner and their spouse, it's a great story. But if you do run into opportunities for worksite business, I don't want to delve into this too deeply. No, we have a unisex employer group rate class. Group approval, getting the group number, really simple process. Everyone's fully underwritten, and minimums are as low as possible. I think the bigger story to tell here is the tax play. Okay, so know that you could have a tremendous tax story to talk about. And if you aren't familiar with how that works with C Corps versus S Corps versus, LLCs that file as an S versus a C and all that, we are more than happy to help you out. Just know that there could be a tremendous tax story to tell. The last sales idea I want to introduce to everybody here is the fact that we do accept business via 1035 exchange. Okay, so most people know you can use life insurance money into long-term care. Most people don't know you can also use non-qualified tax-deferred annuities. The Pension Protection Act expanded what we're allowed to do within Section 1035 to use either of these types of products. And we take the surrender value, the full value, even the gains that they never paid tax on. And if you 1035 that to pay for your long-term care insurance, the benefits that come out the other end are tax-free long-term care benefits. Keep in mind, they never paid tax on those gains. So when you bring up this concept, you kind of have a magic wand waving, turning a potentially taxable asset into a tax-free benefit. Okay. Red flags to look out for. If it's a couple, I have to have a like-for-like transfer. So I can't just take the husband's annuity and stick that into joint long-term care. It's not like-for-like. You have different insureds. But we've had many annuity carriers that let you call them up, add the spouse as a joint annuitant, then I can take that and stick it into joint long-term care. And do keep in mind, I cannot play with qualified money within Section 1035. It must be a non-qualified annuity. And that last bubble is just kind of a reminder. If you sell single premium NGL long-term care, you're selling guaranteed premium long-term care insurance. Great story to tell. So I wanted to share with you the process I saw a lot of advisors having a lot of success with when they talk about 1035 exchanges. At this point, you have financially and medically pre-qualified your client. You have a good idea what their finances look like. Maybe they've already told you, hey, we just want to self-insure using this life insurance or annuity or whatever. Here's where you go from here. You say, look, Mr. Client, I can help you in one of two ways. I can help you transfer the risk of possibly needing care. I'm not saying you will, but if you did, the consequences could be devastating to your family. I can help you transfer that risk to an insurance company and you pay an annual premium for it. Or I can help you do exactly what you told me you want to do. Right? You told me you want to self-insure. But I can help you self-insure better and longer than you would do it on your own. Would you mind if we discussed both of these options? Now, what I basically said was, hey, Mr. Client, I can get you a traditional long-term care policy or I can sell you a hybrid. You want to talk about them? But I didn't use either one of those words in quotes on your screen. There's a lot of subtlety built into that little presentation, right? So the first thing, Mr. Client, I can help you in one of two ways. First key word was help. Second part was two ways. You're providing options, more likely to get an answer. That's yes. So I can help you transfer the risk of possibly needing care. Again, you might not need it, but the consequences, if you do, could be devastating to your family. That's why we're talking. And you pay an annual premium for it. Or I can help you, you're still helping, I can help you do exactly what you want to do. Now you're helping him achieve his goals. I can help you self-insure, but I can help you do it better and longer than you're doing it on your own. Well, how can this guy do that for me? Now you've piqued interest. So at that point, when I heard the advisor say, would you mind if we discussed both of these options? Rarely did I see him get a no or her. So here's where you go from here. Well, Mr. Client, you told me you wanted to self-insure. Generally, I see people doing that with a life policy or an annuity that they bought many moons ago that they don't need for the same reasons today. For example, now you are retired, your retirement income's coming in, house is paid off, kids are through college, okay, your wife is also retired. You don't have that life insurance policy for the same reason. I believe that would be what you're going to tell me you're going to use to self-insure. So let me take that small sliver of your pie, and I'm going to pack it into a vehicle called a 1035 exchange. And I promise you, I can help you self-insure better and longer than you could do it on your own, right? Look at how much larger that piece of your pie got. Now, that could be all tax-free long-term care reimbursements. And if you're concerned for a second that you might die and not need care, I can return it to that original sliver if I had a rider to this thing. And if you think for a second you might ever consider canceling this thing, you can get up to 80% of your money back on or after the 4th anniversary of this policy. And I love the picture of the couple on this slide, kind of looking at themselves and the advisor going, they look a little bewildered, right? That was very accurate to the responses I saw in the field. I had people say to their advisor, how come nobody's told me about this? Is this legal? What kind of policy is this? How does this work? Well, for all of us on the call, it's the stuff we've already talked about. It's traditional long-term care insurance that you can build with lifetime benefits or 3 different benefit pools. And if they're concerned about dying and never needing care, you can add a return of premium rider. If they ever think they might cancel, you can add a surrender value to that return of premium rider. So for everyone on the line, this is kind of where I began. I believe that we have an extremely flexible product that can be what your client wants it to be. And we have the riders and options for you to flex and mold this thing into a tremendously valuable, customizable product that is not only competitively priced, but provides very rich benefits for long-term care. We discussed a few of the sales ideas that are on the bottom of your screen, but know that those are not the only ones. I just see those as being some of the most popular ones. I also want you all to be aware that we have a tremendous quick quote calculator where you can run a quote in about 15 seconds. Please don't write that link down. You will inevitably miss a dot or a slash. I'm sure Leonard can get that out to you after the call if you're interested. By the way, if anyone wants to see a demo of that, just type it in the chat box. Because at this time, I would be more than happy to welcome any questions, comments, concerns, or anything anyone wants to add to what we've discussed today. And as you're typing those in, I just want to thank you all very much for taking time away from your phones today. Hey, as a salesperson, I know how valuable it is for us to be out there and selling, but I really appreciate you coming and taking some time to learn about this product. And Leonard, sir, I can't thank you enough for putting this together so we can all chat and learn more about NGL, because we want to do all we can to help all of you close as many sales as possible and earn the business and be true carrier partners for you. So, Leonard, thank you very much for organizing this, and everyone, thank you for taking the time to listen to today's call.
You're more than welcome, Lawrence. I think the value proposition that National Guardian brings to the brings to the field, brings to the table, are several of the things that Lawrence did cover. A couple of things I just want to add to it. The 1035 exchange has been out there since the Pension Protection Act, but not a lot of the carriers that are still in long-term care will accept 1035s for long-term care business. So that really makes it very, very unique. The return of premium, the surrender value, in those situations where it's important to a client, by all means. And we certainly love the idea of having a limited pay plan, being a 10-year plan, or even a single premium for those clients that are really concerned about rate increases that they've heard about and so on. So I think National Guardian with the EssentialLTC product brings to the table really allows you to design and build something that you're not capable of doing with another carrier. The other thing to keep in mind is that we see it happening now is that this is a product that a producer will utilize when talking with a financial planner because they're all about preserving money. And this is a way that you can approach it from that particular viewpoint. So I'm not going to take a lot more time here today to go back over things because I don't believe that that's necessary. But you all know who I am. Give me a call. I'd be more than happy to send the material that we have or answer any questions that you might have. I'm not seeing any questions from the chat session at this point. So with that, I want to thank Lawrence once again for taking the time to be part of this presentation. We welcome any questions or comments from you. By all means, just drop me an email or pick up the phone. So with that, we want to thank you, and we wish you good selling, in the days and weeks ahead. So we're going to close out for now and say goodbye.